The way most people approach investing is completely wrong. They chase trends, follow the crowd, react to market movements, and hope to make quick profits. But over time, this approach leads to mistakes, losses, and frustration. In The Intelligent Investor by Benjamin Graham, you learn a completely different way to think about investing. One built on discipline, patience, and long-term value. In this audiobook, I'll break down the book chapter by chapter, simplifying its key ideas so you can understand how to approach investing the right way. By the end of this video, you'll understand how to think like an intelligent investor and avoid the common mistakes that hold most people back. Chapter 1. Investment versus Speculation. Benjamin Graham begins the book by defining one of the most important ideas in investing: the difference between investing and speculating. According to him, an investment is an operation that is based on thorough analysis, protects your capital, and offers a reasonable return. Anything that does not meet these conditions is considered speculation. This sounds simple, but this is where most people get it wrong. Many people believe they are investing when they are actually speculating. They buy stocks because they are trending, because everyone is talking about them, or because they expect quick profits. For example, imagine buying a stock just because it's going viral online, or because someone said it will blow. That decision is not based on analysis. It's driven by hype and expectation. That is speculation. Graham makes it clear that there is nothing wrong with speculation, as long as you are aware of it and you control your risk. The real danger is when people speculate but think they are investing. Another key idea in this chapter is that the market is unpredictable in the short term. Prices move based on news, emotions, and crowd behavior, not always on real value. That is why Graham emphasizes something very important. The intelligent investor focuses on value, not price. A true investor does not panic when prices fall, does not get carried away when prices rise, and does not chase quick gains. Instead, they stay disciplined and think long-term. Graham also highlights that behavior matters more than intelligence in investing. You can have knowledge, but still fail if you panic during downturns, get greedy when the market is rising, or follow the crowd without thinking. In the end, the biggest enemy of the investor is often not the market, but themselves. To sum it up, in Chapter 1, Benjamin Graham explains that investing is not the same as speculation. True investing requires discipline, analysis, and long-term thinking, while speculation is driven by emotion and short-term movements. The key lesson is simple. Don't just invest your money. Understand what you're doing and why you're doing it. Chapter 2. The Investor and Inflation. In this chapter, Benjamin Graham explains how inflation affects your money over time and why every investor must take it seriously. His main point is simple. Inflation reduces your purchasing power. This means that even if your money stays the same in numbers, it becomes less valuable over time because prices increase. For example, something you can buy today for $10,000 might cost $15,000 or more in the future. If your money is not growing, you are actually losing value without realizing it. This is why Graham emphasizes that saving alone is not enough. You must invest to grow your money. However, he also warns against reacting emotionally to inflation. When people hear about rising inflation, they often panic. They rush into investments, chase trends, or make decisions based on fear, thinking they are protecting their money. But Graham makes it clear. Reacting out of fear often leads to worse decisions than inflation itself. He explains how different investments respond to inflation. Stocks can perform well over time because businesses can grow and adjust prices. Bonds provide stability, but may lose value in real terms when inflation rises. This leads to an important idea. No single investment is perfect. That is why Graham supports diversification, spreading your money across different types of investments to reduce risk. Another key lesson is that inflation is unpredictable. No one can accurately forecast how it will behave in the short term. So instead of trying to guess, investors should build a long-term strategy that can handle different economic conditions. The deeper message here is that staying calm and disciplined is more important than trying to outsmart inflation. To sum it up, in Chapter 2, Benjamin Graham teaches that inflation quietly reduces the value of money. So investors must focus on growing their wealth, not just saving it. The key lesson is simple. Don't ignore inflation, but don't let fear of it control your decisions. Chapter 3. A Century of Stock Market History. In this chapter, Benjamin Graham uses history to teach one powerful lesson. The stock market moves in cycles. Over time, the market goes through periods of growth, decline, optimism, and fear. These cycles repeat again and again. Graham shows that during periods of strong growth, many investors become overly confident. They believe prices will keep rising, so they rush in, invest heavily, and sometimes take unnecessary risks. For example, when the market is booming, people often say things like, "This time is different." Prices will keep going up. You can't lose in this market. But history shows that these moments are often followed by sharp declines. On the other hand, when the market is falling, fear takes over. Prices drop, people panic, and many investors sell their investments at a loss. Ironically, these are often the best times to invest. This leads to one of the most important ideas in this chapter. The market is driven more by human emotions than logic. Greed pushes prices too high. Fear pushes prices too low. Because of this, Graham warns investors not to follow the crowd blindly. Another key lesson is that short-term market movements are unreliable, but long-term trends are more meaningful. Even though the market goes through ups and downs, it has historically grown over long periods. That is why Graham encourages investors to focus on the long term instead of reacting to daily changes. He also emphasizes that history is one of the best teachers in investing. By studying past market behavior, investors can better understand how bubbles form, how crashes happen, and how emotions affect decisions. The deeper message is simple. Market conditions may change, but human behavior stays the same. To sum it up, in Chapter 3, Benjamin Graham teaches that the stock market moves in cycles driven by greed and fear. Periods of excitement often lead to overvaluation, while periods of fear can create opportunities. The key lesson is simple. Don't follow the crowd. Understand the cycle and think long-term. Chapter 4. General Portfolio Policy, the Defensive Investor. In this chapter, Benjamin Graham introduces the idea that not all investors are the same. He divides investors into two main types: the defensive, passive investor, the enterprising, active investor. This chapter focuses on the defensive investor, someone who wants to invest safely, simply, and with minimal effort. The defensive investor is not trying to beat the market or chase high returns. Instead, their goal is to protect their capital, avoid serious mistakes, and achieve steady, reasonable growth over time. Graham makes it clear that this approach is not weak. It is smart and disciplined. Many people believe they need to constantly monitor the market, pick the best stocks, and make frequent decisions to succeed. But Graham argues that this often leads to more mistakes, not better results. For example, Someone who is always buying and selling based on news or emotions may feel active, but they are also increasing their risk of making poor decisions. In contrast, the defensive investor keeps things simple. Graham recommends a balanced portfolio of stocks for growth and bonds for stability. He suggests that a defensive investor should never put all their money into one type of investment. Instead, they should maintain a mix, typically somewhere between 25% to 75% in stocks, and the rest in bonds. This balance helps protect against extreme losses while still allowing for growth. This introduces a very important principle. The goal is not to maximize returns. It is to manage risk. Another key idea in this chapter is that consistency beats activity. A defensive investor does not chase trends, react to every market movement, or try to time the market. Instead, they stick to a plan and make adjustments only when necessary. For example, if stocks grow too much and take up a larger portion of the portfolio, the investor may rebalance by selling some stocks and buying bonds. This keeps the portfolio stable and aligned with their strategy. Graham also emphasizes that simplicity is an advantage. You don't need complex strategies or constant decision-making to succeed. In fact, trying to do too much often leads to confusion, stress, and poor results. The deeper message of this chapter is that a well-structured, disciplined approach is more powerful than constant action. To sum it up, in Chapter 4, Benjamin Graham teaches that the defensive investor focuses on safety, simplicity, and long-term stability. By maintaining a balanced portfolio of stocks and bonds and avoiding unnecessary activity, they reduce risk and improve their chances of steady success. The key lesson is simple. You don't need to do more to succeed in investing. You need to do the right things consistently. Chapter 5. The Defensive Investor and Common Stocks. In this chapter, Benjamin Graham explains how a defensive investor should approach investing in stocks. His main point is simple. Not all stocks are suitable for a defensive investor. Because the defensive investor's goal is safety and stability, they must be selective about the type of stocks they buy. Graham recommends focusing on high-quality, established companies, not risky or speculative ones. These are companies that have a strong financial position, have been operating for many years, have a consistent record of earnings, and pay regular dividends. For example, instead of chasing a new, fast-rising company with uncertain future profits, a defensive investor would choose a stable company with a long track record, even if its growth is slower. This introduces a very important principle. Stability is more important than excitement. Many investors are attracted to stocks that are hot or rapidly increasing in price. But Graham warns that these types of stocks often come with higher risk and uncertainty. Another key idea in this chapter is diversification within stocks. Graham advises that a defensive investor should not rely on just one or two stocks. Instead, they should spread their investments across multiple companies. For example, instead of putting all your money into one company, you might invest in 10 to 30 different well-established companies. This reduces the impact if one of them performs poorly. This leads to another important lesson. You don't need to pick the perfect stock. You need to avoid the wrong ones. Graham also introduces the idea of valuation. Even a good company can be a bad investment if you pay too much for it. That is why the defensive investor should avoid stocks that are overpriced, driven by hype, or trading far above their actual value. The focus should always be on buying quality at a reasonable price. For example, if a company is doing well but its stock price is extremely high compared to its earnings, it may not be a wise investment. The deeper message of this chapter is that discipline and selectivity protect you from unnecessary risk. To sum it up, in Chapter 5, Benjamin Graham teaches that the defensive investor should focus on strong, stable companies, diversify their investments, and avoid overpaying for stocks. The key lesson is simple. Choose quality over hype and always pay attention to value, not just price movement. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. In this chapter, Benjamin Graham shifts focus to the enterprising, active investor, someone willing to put in more time, effort, and research to potentially achieve better results. But instead of starting with what the enterprising investor should do, Graham first explains what they should avoid. This is why he calls it the negative approach. His main point is simple. Success in investing often comes from avoiding mistakes before trying to achieve gains. Graham warns that many investors fail, not because they lack opportunities, but because they fall into common traps. He highlights several types of investments the enterprising investor should be cautious about. 1. Overhyped or popular stocks. These are stocks that are widely talked about and heavily promoted. For example, when everyone is excited about a particular company and its price is rising quickly, many investors rush in, expecting easy profits. But Graham warns, when something is popular, it is often already overpriced. 2. New issues, IPOs. These are stocks being offered to the public for the first time. While they may seem exciting, Graham points out that new issues are often priced in a way that benefits the sellers, not the buyers. In simple terms, you are often paying a premium for something unproven. 3. Low quality or speculative stocks. These include companies with weak financials, inconsistent earnings, or uncertain futures. They may look cheap, but they are risky. Graham emphasizes that cheap does not always mean good value. 4. Complex or